this section, we will talk about how to cash out stocks and lock in your gains when the market is doing well. Cashing out stocks means selling your shares and converting them into cash. Locking in gains means protecting your profits from a possible decline in the stock price. There are several reasons why you might want to cash out stocks and lock in gains. For example, you might need the money for a big purchase or an emergency fund. You might also want to diversify your portfolio and reduce your exposure to a single stock or sector. Or you might simply want to take advantage of a favorable market condition and enjoy your hard-earned returns. But how do you cash out stocks and lock in gains without paying too much in taxes or missing out on future opportunities? There are a few strategies that can help you achieve this goal. One strategy is to sell your stocks gradually over time, rather than all at once. This way, you can spread out your capital gains tax liability and avoid triggering a higher tax bracket. You can also use a dollar-cost averaging approach, which means selling a fixed amount or percentage of your shares every month or quarter, regardless of the market fluctuations. This can help you avoid selling at the wrong time and smooth out your returns. Another strategy is to use a stop-loss order or a trailing stop order to automatically sell your stocks when they reach a certain price level. A stop-loss order is an order you place with your broker to sell your shares if they fall below a specified price. A trailing stop order is similar, but it adjusts the price level as the stock price rises. For example, you can set a trailing stop order to sell your shares if they drop 10% below their highest point. This way, you can lock in some of your gains and limit your losses if the stock price reverses. A third strategy is to use options to hedge your position and protect your profits. Options are contracts that give you the right, but not the obligation, to buy or sell a stock at a certain price and time. There are two types of options: calls and puts. A call option gives you the right to buy a stock, while a put option gives you the right to sell a stock. One way to use options to lock in gains is to buy a protective put. A protective put is a put option that you buy for a stock that you already own. For example, if you own 100 shares of XYZ stock at $50 per share, and you buy a put option with a strike price of $45 and an expiration date of 6 months, you have the right to sell your shares at $45 anytime within the next 6 months. This means that even if the stock price drops below $45, you can still sell your shares at $45 and lock in some of your gains. Another way to use options to lock in gains is to create a costless collar. A costless collar is a combination of buying a protective put and selling a call option for the same stock. For example, if you own 100 shares of XYZ stock at $50 per share, and you buy a put option with a strike price of $45 and sell a call option with a strike price of $55, both with an expiration date of 6 months, you have created a costless collar. This means that you have limited your downside risk to $45 per share and your upside potential to $55 per share. You have also paid nothing for this strategy, because the premium you received from selling the call option offsets the premium you paid for buying the put option. These are some of the ways you can cash out stocks and lock in gains when the market is doing well. Of course, these strategies have their own pros and cons, and they may not suit every investor's situation and goals. Therefore, before you decide to use any of these strategies, make sure you understand their risks and benefits, and consult with a financial professional if needed. One of the most important aspects of investing is to rebalance your portfolio regularly. Rebalancing means adjusting the weights of your assets to match your target allocation and risk level. This can help you achieve better returns and reduce your exposure to market fluctuations. But how do you rebalance your portfolio and diversify your investments? Here are some steps you can follow. Set your target allocation. This is the ideal mix of stocks, bonds, cash, and other assets that suits your goals, time horizon, and risk tolerance. For example, if you are a young and aggressive investor, you might want to have 80% stocks and 20% bonds in your portfolio. If you are older and more conservative, you might prefer 40% stocks and 60% bonds. create bands around your positions. These are ranges of acceptable deviation from your target allocation. For example, if your target is 80% stocks and 20% bonds, you might set a band of plus or minus 5%. This means that you will rebalance your portfolio when your stock allocation goes above 85% or below 75%, or when your bond allocation goes above 25% or below 15%. Check your portfolio regularly but not obsessively. You don't need to monitor your portfolio every day or every week. You can check it once a month, once a quarter, or once a year, depending on your preference and availability. The key is to be consistent and disciplined. Be strategic about which account you rebalance in. If you have multiple accounts, such as a taxable account, a Roth IRA, and a 401k, you should consider the tax implications of rebalancing. Generally, it is better to rebalance in tax-advantaged accounts, such as IRAs and 401ks, because you don't have to pay taxes on capital gains or dividends. If you rebalance in taxable accounts, you might incur taxes on selling appreciated assets. Use tax loss harvesting strategies to mitigate taxes. If you have to rebalance in taxable accounts, you can use tax loss harvesting to offset some of the taxes. This means selling assets that have lost value and using the losses to reduce your taxable income or capital gains. For example, if you have $10,000 of capital gains and $5,000 of capital losses, you can use the losses to reduce your taxable gains to $5 by your underperformers on sale. Rebalancing also gives you an opportunity to buy low and sell high. When you rebalance your portfolio, you are selling assets that have performed well and buying assets that have performed poorly. This can help you take advantage of market cycles and increase your long-term returns. Think like a robot. Rebalancing can be emotionally challenging because it goes against our natural tendency to chase winners and avoid losers. However, rebalancing is not about timing the market or predicting the future. It is about sticking to your plan and following a systematic process. You can use tools like robo-advisors or automatic rebalancing features to help you rebalance your portfolio without human bias or interference. By following these steps, you can rebalance your portfolio and diversify your investments effectively. This can help you achieve your financial goals and protect your wealth from market volatility. How to exercise stock warrants and take advantage of favorable price movements. Stock warrants are contracts that give you the right to buy or sell a certain stock at a fixed price before a certain date. They are similar to stock options, but they are issued by the company instead of an option writer. Stock warrants can be a great way to profit from the midday stock moves of companies like Logitech, Toyota, UnitedHealth, AMD, and more. But how do you exercise stock warrants and take advantage of favorable price movements? Here are some steps to follow. Check the strike price and expiration date of your stock warrants. The strike price is the price at which you can buy or sell the stock, and the expiration date is the deadline for exercising your warrants. You can find this information on your warrant certificate or contract. Compare the strike price with the current market price of the stock. If the current market price is higher than the strike price of a call warrant, which gives you the right to buy, or lower than the strike price of a put warrant, which gives you the right to sell, then your warrant is in the money and has intrinsic value. This means that you can exercise your warrant and make a profit by buying or selling the stock at a favorable price. Decide whether to exercise or sell your stock warrants. If your warrant is in the money, you have two options. You can either exercise your warrant and buy or sell the stock, or you can sell your warrant on the secondary market and pocket the difference between the warrant price and the market price. The best option depends on several factors, such as your risk tolerance, your expectations for the stock's future performance, and the time value of your warrant. Contact your broker and tell them what you want to do with your stock warrants. The easiest way to exercise or sell your stock warrants is through your broker, who will handle most of the paperwork and communication with the company that issued the warrants. Your broker will likely charge a fee for this service, so make sure you factor that into your calculations. enjoy your profits or cut your losses. If you exercised your stock warrants and bought or sold the stock at a favorable price, you can either hold on to the stock or sell it for a profit. If you sold your stock warrants on the secondary market, you can either reinvest your proceeds or cash out. If your warrant expired out of the money, meaning that it had no intrinsic value at expiration, then you lose your initial investment in the warrant. Stock warrants can be a powerful tool to leverage your returns from the midday stock moves of various companies. However, they also come with risks and costs, so make sure you understand how they work and what they entail before investing in them.